We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Alfredo Pinel, Head of Research at gameoftrades.net. How are you today, Alfredo?
I'm doing great, Tom. Thank you for having me.
Great to have you. And of course, we had a discussion the other day around really how you guys as a group are looking at the economy, the markets, metals, and energy here. And I think it's going to be an interesting discussion to be able to go through all of this and really get your guys' bird's eye view of how all of these different trends are developing. So why don't we start a little bit? Obviously, you're a new guest to the show. Tell us a little bit about your background and what brought you to the position that you're in now.
Absolutely, Tom. So my name is Alfredo Pinel. I am the head of research at Game of Trades. And prior to joining Game of Trades, I was a global equity strategist at Empirical Research Partners in New York City. And what brought me to Game of Trades was a conversation with the founders of the firm, Peter and Edward, and they were very enthusiastic about the idea of being able to provide macro investment research, primarily to individual investors and also financial advisors, regardless of their level of expertise. We have a vision that we shared in that regard, that investors of any kind can achieve success in the markets if they have data-driven research and they have actionable strategies that they can implement successfully. So there are two things that we feel that we can solve in the market today at Game of Trades. One of them is that there's a lot of market noise for investors today. Investors are just bombarded continuously with excessive amount of noise and sometimes misinformation that they find on the internet. And this creates just huge obstacles for them to be able to make informed investment decisions. And also we're looking to simplify the information, because even if investors have reliable information, it can get overwhelming. There's just too much information. Sometimes it can get very complex. It can get very difficult for individual investors to understand the data and to be able to apply them successfully in their investments. So our team at Game of Trades has substantial industry experience where we can actually provide actionable investment strategies, data-driven research for investors to help them navigate the market, to really distill things to their key dynamics so that investors know exactly what they need to know to make reasonable investment decisions.
Mm-hmm. Yeah, I think it's always, very helpful to be able to understand these larger trends. The idea of looking at macro trends and how to take steps, as you said, to make actionable, trades or whatever it's going to be, not necessarily even trades, but, seeing these trend changes, I think are extremely valuable. And obviously it's really helpful to start by talking about that macro backdrop, what it looks like and what trajectory a lot of these, changes are going to bring to the markets. So what is the stock market telling us right now about, let's say, the outperformance of low volatility stocks versus high beta stocks? And what is that ratio, when we're looking at that, what is it really telling us?
Right. That's a great question. You're right. Now, investors are very much focused on this idea of a risk-off rotation in the market, given these concerns about rising real rates. And real rates are a negative for valuations of the market, especially when a big part of that market, the S&P 500, is made up of these technology companies that have a very large representation of the market. Around 28% of the S&P 500 market capitalization is made up of these tech companies that are priced at high valuations. So I think as a starting point, when you look at today, valuations is a very interesting observation that we went into this year pricing in this Fed pivot, and the price to earnings ratios of the S&P 500 rose up materially going into this Fed pivot. And basically, if you look at the data going back decades, that's never really been the case. Investors don't discount a Fed pivot in advance. They do so after the Fed actually pivots. And this time has been different. So the starting point already has been one that's been making the S&P 500 vulnerable to these bad news that have come to fore, essentially the rise in interest rates, primarily driven by these concerns around fiscal sustainability, the Treasury issuing massive amounts of duration. So that is a problem for the S&P 500 today. That the starting point has just been a difficult one. Now, in terms of the rotation, you bring up a good point. Is this performance of the low volatility stocks, or stocks, for example, that are comprising staples, healthcare, utilities, these traditional defensive sectors? These companies have been outperforming the high beta stocks, which are the riskier stocks in the market that have a high exposure to the economy. They've been outperforming since July, when we had the local top in the S&P 500. And that rotation is an important one to track. It's telling us that the market is getting worried that these concerns around interest rates, just in the same way that they happened last year, could be, in effect, leading investors to rotate out of tech, out of these cyclicals, and into these defensive parts of the market. And primarily because we have seen the valuations of these defensive stocks collapse this year. So the valuations of defensive stocks, especially relative to things like tech, have come down significantly in this year, because investors have been pricing in this Fed pivot, this soft landing, in essence saying, why do we need defensives when the economy is going to do well? And essentially we're going to bet on these stocks that have high growth potential like tech. Mm-hmm. So that's been an important observation. It's just that long-term investors are seeing the market right now. They're saying interest rates are moving higher, potentially structurally higher. The valuations of tech companies that are very vulnerable to rising interest rates are high, yet these defensives that tend to work well, like they did last year when interest rates are moving higher, they're very cheap right now relative to the market. And from that standpoint, if the concerns are a little bit more structural and longer term, in essence, that investors are not getting paid to make big bets on the market right now, then these defensives are looking very attractive. So I think that's a key observation right now, is the performance of these defensive sectors and their valuations, and how that stacks up against these concerns that are related to interest rates that could actually turn out to be a little bit more long-term and structural in nature.
Mm-hmm. So, Alfredo, when we're thinking about, let's say, the opportunity that a rotation in capital, let's say a rotation from growth stocks back to value stocks, does that really open an opportunity in stocks like, let's say, consumer staples, because of their unattractiveness over the last couple of years, and seeing that trend change, that can be an actionable step to be able to get back into, staple type value plays from those big growth type plays?
Yeah, I think the question about growth versus value has been one that's dominated the conversation among investors for many years. Mm-hmm. I would say that in today's environment, if you look at what transpired last year, when you had these concerns around interest rates potentially triggering a recession, the probability of recession rose materially last year. Defensives really proved a good place to be for investors, and from that standpoint, you have to take a close look at that and say, where we are today in terms of the risks, right? The underlying issue here is the potentially structural rise in interest rates, given these concerns around fiscal debt and the massive treasury of supply of bonds. From that standpoint, the defensives here are looking a little bit more attractive than other parts of the market. One thing I would also mention is that you really have to look as an investor, what is exactly the issue here in terms of the risks. And as I mentioned, it has to do with interest rates. And when you look at what bond investors are paying attention right now in terms of the concerns around rates, the implied volatilities for interest rates, and there's an index that we can look at, is the MOVE index, for example. Mm-hmm. That type of volatility, meaning that what is the expectation of risk or volatilities that bond investors are pricing in, That volatility right now is in the top quintile of the history going back to 2000. So bond investors are very much not complacent with where things are right now. They're very much uncertain around the path of interest rates. And when you look at the VIX, on the other hand, so equity market volatility, it's in the 50th percentile going back to 2000. So there's definitely a very big dislocation right now in terms of the risks that are perceived in equities versus bonds. And if the concerns are very much related to interest rates, as an equity investor, you should be paying attention to what bond investors are worried about. So that type of dislocation means that the concerns around equities may have some legitimacy, and you might see the VIX move higher and catch up to the level of the move. In essence, the market saying that the equity market was too complacent and that these concerns around rates need to be respected. So from that standpoint, it's also for me some sort of validation that defensives are probably where investors need to be looking at given these concerns.
So when we think about that dislocation of let's say the MOVE index versus the VIX, do they typically track each other fairly closely? And now we're just seeing this dislocation, and it has to resolve, typically reverting to that kind of correlation, right?
Yes, the MOVE index and the VIX index tend to move together, and we can probably show a chart on that in the podcast. But indeed, there's been a dislocation more recently, and I think it has to do with this idea of the soft landing. That this year investors in the equity market have been very complacent, assuming that the Fed will achieve a soft landing and bring inflation back to target without much disruption to the labor market or earnings. And that's really been what equity investors are standing for. In the bond market is very different. In the bond market, investors are very worried about the path of interest rates and these concerns around fiscal sustainability. I think a lot of it has to do in terms of what could explain this dislocation, the soft landing as we mentioned, but also this idea that we have lived in the last decade or so in this world of low interest rates, and equity investors may be thinking that we're really not going to see much different outcome from what we experienced in the last decade after the financial crisis, and that it's unlikely that we're going to see a world where interest rates structurally move higher and create this massive economic volatility in terms of recessions, for example, or inflation, and that we're not going to see that type of economic volatility like we had seen in prior decades. That's also, I think, structurally something that could be playing out, and that equity investors need to make a decision and really have a view about long term where we're headed.
Well, when we think about, let's say, the effect of those higher interest rates on companies in the S&P, has there really been, let's say, an earnings recession in the S&P 500, and what does that indicate to us about the economy?
Yeah, the earnings on the S&P 500 have taken a little bit of a hit this year, and the big call of the analyst community is that we're basically going to see a turnaround in the earnings, an inflection point higher here in the second half of this year and next year. That we're going to see this rebound in earnings, and again, that's very much the view of a soft landing, that we're not going to see this impact from monetary policy tightening come in and disturb the earnings of the companies. So from that standpoint, that is the bet that equity investors are making. That's the consensus view right now, and that's a big bet when you look at what's going on with the leading economic indicators. There's a very big divergence between leading economic indicators and what the analyst community is expecting for earnings growth going forward. Now, it could be that the leading economic indicators are just plain wrong, and equity investors have a better sense about what's going on. That could happen. But in the past, if you look at, for example, even 2008, and I'm not saying that we're going to have a financial crisis, but in 2008, you saw a similar circumstance where going into the financial crisis, analysts were getting very bullish on earnings. and they were expecting earnings growth, while the leading economic indicators were collapsing. And ultimately, we know what ended up happening. So it is not unusual for analysts as a community to be wrong in making these types of calls. And it's just very uncertain right now in terms of the macro for somebody to really be making these type of big, bold bets on equities. The risk reward is just very poor.
Yeah, I think that's a great way to put it. It seems like there are so many contrary indicators in this market environment that I think I've spoken to countless people that say this is the most challenging time to pick a direction that they've ever faced. But Alfredo, combining this, let's say the zero rate environment that we've had for many years with the rate hiking schedule that the Fed embarked upon starting last year, one would have thought the economy would have already rolled over and entered recession. So do you have an explanation as to why, let's say, the labor market has proved to be so resilient? Or is this more of an artifact of the data that doesn't capture the change in, let's say, the quality of jobs, where people are, the statistics show that the labor market is keeping up, but it doesn't necessarily reflect the loss of full-time jobs with benefits?
Right. Yeah, that's been, I think, one of the key issues for many investors that think about the macro in terms of their views. It's this type of cycle. What type of cycle is this? And unfortunately, as you mentioned, it's been extremely challenging, mainly because I think COVID was a very unusual event. If you look at the history of cycles going back 100 years, and that's introduced a lot of uncertainty around the impact of monetary fiscal policy, for example, and the stimulus. What does that really mean for the economy? We haven't seen stimulus this size in a very long time. So, what does that mean? And I think when you look at it, you can conclude that the fiscal stimulus was being a big part of it in terms of these expectations that many investors have had that by now we should have seen a recession. Balance sheets of corporates and also of households have been benefited by the big fiscal stimulus that was injected, and also the excess savings. That created a lot of excess savings, which we define as basically just the savings that accumulated in balance sheets of households that were counterfactual or unexpected relative to the trends that prevailed before COVID. And that's also helped insulate a lot of these rate hikes among investors. Now, one thing that I would say is that if you look at the labor market, and we track that religiously, because it's really the source of vulnerability in terms of our thesis. Mm-hmm. If you look at the labor market and look at the unemployment rate, and you compare what's happened this time around after the inversion of the yield curve last year versus prior yield curve inversions that, going back decades, there hasn't really been that much of a reason or justification or argument to say that things are looking different from what we've seen before. The unemployment rate, in terms of its trajectory, has been tracking closely the median episode from an inversion that has occurred over the last decades. And we put a lot of emphasis on the yield curve inversion in our thinking about the macro because it's a quantitative signal. It is unbiased in our view. It has a great track record of predicting recessions. It's not perfect, and that's why it's only one of the things that we look at. But it is a great tool to use to assess where we stand in the cycle. So from that standpoint, the unemployment rate not spiking this year is really not a huge threat to our thesis. But we would say that in the next few months, we should see an inflection point higher, which is what typically happens after these inversions. Around the 15-month mark, we should be see after the inversion occurs. So, we're thinking in the second half of this year, in the next few months, and Q1 of next year, mm-hmm. we should be seeing an inflection higher in the unemployment rate. I will also say that this argument that monetary policy tightening hasn't really impacted the economy, it's only because back in March, when banks were failing, the Fed and the FDIC backstopped the system. That very much is, if you look at banks and you look at rate sensitivity, you would expect that the banks would be feeling the brunt of the rate sensitivity of the economy if the Fed embarked in a very aggressive rate hiking cycle like it did. It's only because the Fed backstopped the system that we didn't see potential more failures in the banking system. It may not have been another financial crisis, but you could have seen many more failures in the banking system. And also just, consumer sentiment could have plummeted, and companies may have laid off or embarked in a campaign of laying off, which, there were a lot of companies that were considering doing that even just in the days after the failure of SVB. So we have to adjust for this, for the fact that the Fed came in and backstopped the financial system, and that for us is an indication that the economy is rate sensitive. It's just that you as an investor, you're not going to fight the Fed or the FDIC, and that's something that equity investors have had to adjust. So from that standpoint, I would say the argument that the economy is not rate sensitive, it's not entirely true when you take into account what's happened with the banks, which is where a lot of the risk, given this fiscal stimulus, built up, because the balance sheets of the banks rose significantly. The deposits rose significantly because of that money that was injected into the economy flew or got injected into the balance sheets of these banks. So a lot of the rate sensitivity was built up there. It's just that it never got a chance to explode.
Mm-hmm. Do you think, though, that just bought some time, considering the mismatch of a lot of those assets, or I guess assets and liabilities, considering that duration mismatch, that program just bought them time, and that we are going to see more fallout from this extreme, rate hiking cycle?
Well, I would say the issue now is, as an investor, if you're looking at what's happening with the banks, it's a very difficult proposition to say that things are going to blow up. When the Fed and the FDIC were involved in guaranteeing deposits and providing liquidity funding to banks, which they have taken out quite a bit, so you would say that program has been a success. It's difficult to say that things are now going to get worse from that's going to be, let's say, the catalyst for a financial crisis or a recession, because I definitely understand that the bonds held by these banks in balance sheets have a valuation issue because of the rise in interest rates. They've also been taking steps to hedge their duration risk, and regulators have been pretty much working with them and pressuring them in raising capital and adjusting their duration risk, hedging. So from that standpoint, I would say the odds are probably not that favorable that that's going to be the source of a recession or a financial crisis, the way we see it today. But we would say that the vulnerability is really more on the earnings side of the regional banks, for example. Those are the banks that we are seeing evidence that, for example, credit card default rates are jumping for customers of regional banks. That's what the data from the Fed is showing, and it's actually the default rate is at significant levels today, indicative of recession. That's not the case for credit cards. The credit card businesses of the biggest banks, for example, you're not seeing huge default rates there, even though they're inflecting higher right now. But the concerns really, in my view, are really more about the earnings of these regional banks and the concerns happening around default and delinquencies, and also this issue about the deposits of the regional banks being threatened by the rise in the short rate, because mutual funds, money market mutual funds right now are capturing a huge amount of assets from households. That's putting pressure on banks to compete and to increase their deposit rates, which increases the funding cost of these banks, which has an impact on lending. Lending growth is expected. We expect lending growth to take a hit from this, and when you look at what's driven the job growth since the pandemic in the economy, it's been small companies. And these small companies are being funded by regional banks, by small banks. 60% of the job growth came from these small firms that are being serviced by the small banks. So if these small banks are now in a situation where they can't lend as much as before, then that's going to put some pressure on the job market.
So, Alfredo, considering, let's say, that rise in the tightness of lending standards, has that been driven by this tightening of financial conditions that the Fed has stepped in and, put into the market? And that is really one of the, let's say, the catalysts for this, what we assume to be a rise in unemployment coming.
Yeah, I think the question about how long will the monetary policy lags come into the system or impact the system is a difficult one to answer. And the traditional cycle would be one where it takes some time, perhaps a year and a half, to see this effect play out in the economy, where you see the cost of funding increase and then impacting the earnings, and of course lending standards get tighter. Banks stop de-risking their loan books, and therefore you see a slowing down of the economy. We think that still can be the case this time around, and it's a matter of looking at what the history has shown in the past. The yield curve inversions have been very good indicators of monetary policy and its impact to the economy, assuming a certain lag for that to take effect. And we are starting to see that play out. I would say that in the US, given the size of the fiscal stimulus, it could be that may take some time to actually realize. But in other economies, like in Europe, for example, we have seen that the impact be much quicker. And right now, if you look at credit demand in Europe by corporates for Q2, was recently reported by the ECB to be at one of the weakest levels going back 2 decades. So it is the case, I think, that in an economy like Europe, where inflation has been a bigger problem, that an economy that didn't see that big of a fiscal stimulus injection to the economy, and that's obviously been impacted by the rise in interest rates put in by the ECB, you're starting to see there the effects of monetary policy impact in the traditional sense of the policy. So I think in the case of the U.S., it could be that it takes maybe a little bit more time. But what one should also take into account that there are spillover effects. If Europe is weakening, for example, that's something that could also spill over into the U.S. And that's something that we can also talk about later on. But I would say that a prime example of the fact that we're not in a different type of dynamic, meaning that rate hikes are not going to impact the economy. We're not of that view. You can simply take a look at Europe and see that that's a classic case of what typically happens when the central bank raises interest rates, and there's potentially even the risk of a policy mistake.
Mm-hmm. Before we move to the Europe question, I'd like to just focus a little bit more on, let's say, what this means for the average consumer. When I spoke to Danielle DiMartino Booth, which was several months ago, credit card debt was just under $1 trillion and growing. It was at its highest level ever. And I think the more important metric from that is, the idea that these people can't service that amount of debt. So is there a growth, or is there an acceleration in the amount of defaults that we're seeing all across the board, from, let's say, lower quality institutions to higher quality credit card providers as well?
Yes, we track that type of data. We look at default rates in credit card loans, for example, and we can definitely see that there's been an issue for the lower credits, the riskier credits, as tracked by the smaller firm, the smaller banks. So there's been a big spike in default rates there. And of course, a lot of that has to do with some things that we already mentioned, like this fiscal stimulus fading and the excess savings depleting. In our view, excess savings have already depleted. And I think that's a big issue for some of these households that had seen a significant improvement in their financial picture after the fiscal stimulus, and now that these excess savings are running out, and also if you look at the moratorium on student loans, for example, that's getting lifted, you're already starting to see these issues play out. And if you look at credit card spending, if you look at data from the Bureau of Economic Analysis that has an indicator on credit card spending on a real-time basis, that's been declining as well. There's been a very significant swoon since late August, which probably is coinciding with this lifting of the student loan moratoriums. A lot of people are looking at that and saying, well, I'm going to have to cut my expenditures. And therefore that, those things are starting to play out. It is being evident in the real-time data. It's not the case that the consumer is getting stronger. And if you look at the data from credit card spending, or the more recently released data from the government on Q2 consumer spending, it came in weaker than expected. So those concerns are very much evident in the data right now, that the consumer is not getting stronger and it's getting weaker.
Mm-hmm. Alfredo, as we think about that question of Europe and, let's say, the effects of higher rates on that economy that is clearly rolling over harder than the US at this point, how does that, provide the possibility that it could spill over to the rest of the world?
Yeah, we have done some work on that. When you look at, for example, big economies worldwide, like China and Europe, those are two very cyclical economies exposed to global trade, which has been weak. It's very evident that the biggest spillover effects between those two come from Europe. And Europe is, part of Europe, part of that economy is basically a play on China. It's a derivative of China, because Germany in particular, a big part of Europe, a big part of that economy, has China as a big client. They export a lot of cars, they export a lot of capital equipment, and same thing with France, for example. They export a lot of luxury goods to China. So China is a big client of Europe, and China has been weakening, as we know, given their housing downturn. So that's impacted Europe significantly, and that's going to spill over to the U.S. economy. So we've done that type of work where we see that when you have these negative growth shocks in Europe going back decades, what tends to happen is that the S&P 500 sees negative returns. They're negatively impacted by these types of growth shocks. And what tends to work is bonds. Treasury bonds outperform during these types of episodes. Cyclical commodities like oil and copper do very poorly. And even gold to some extent doesn't do that great, because the dollar in these types of circumstances, when the concerns are coming from abroad, the dollar strengthens, and that impacts precious metals like gold, where the dollar is a key driver in terms of the fundamental drivers of the commodity. So we live in a global economy today that's very much interlinked, and Europe is a big part of the S&P 500 revenue and earnings generation. A significant share of revenues and earnings from the S&P 500 come from Europe, because a lot of these S&P 500 companies are multinational companies with exposures there. And in fact, we already see evidence in Q2 of this year, where if you look at the earnings reports, companies with exposures to non-US, if you look at, for example, companies with revenue exposure over 50% in non-US, are seeing big declines in revenue growth and in earnings growth compared to those companies that don't have as much exposure to global markets or foreign markets. So this idea that Europe is looking scary and the economy is weakening there, and that's now going to spill over into the U.S. is not correct. So that's another vulnerability that equity investors need to be looking at, aside from what's happening in the economy today. These concerns about monetary policy tightening globally after this aggressive rate hiking cycle that happened globally are being felt right now in Europe, and that could spill over to the US.
As we think about this dollar strength, Alfredo, the dollar has yet lagged real rates. So do we typically see a mean reversion in the strength of the dollar back to kind of getting towards a spot where it's matching real rates?
Yeah, it's difficult sometimes to draw comparisons historically, because I think one really needs to look at what's happening today and understand the dynamics that are prevailing today. I mean, I would say that real rates and the dollar tend to move together, but I think that's really been mostly the case after the pandemic, because the dollar represents, after the pandemic, has been a proxy for Fed monetary policy. Given the aggressive hiking cycle, the Fed, was hiking into a strong economy. The dollar fed into that, and therefore the dollar moved higher as a result of that type of dynamic. Now, what we've seen this year is that real rates have moved higher and the dollar has lagged. For us, that's a concern, because if you look at it in terms of that dynamic, what's happened in our view is that the dollar saw a meaningful reversion from the peak last year, because there was a lot of optimism around China. And there was also a lot of optimism about Europe. If you recall, late last year, the market was very worried about the draconian COVID policies in China and the contraction of that, or the deceleration of that economy, and also about Europe regarding their energy crisis and the potential for them to see a very deep recession caused by this energy crisis. So there was a lot of pessimism priced in markets around these two big macro concerns. And as we recall, China came in around November and said that they were going to remove these draconian COVID policies and let the economy reopen. And that was a massive macro event in terms of the repricing of the dollar. And of course, as we mentioned, Europe is a derivative of that. The market also got very enthusiastic about Europe, because the trade relationships that exist between Europe and China. So between Europe and China, and Europe would see a big benefit out of that. So that was a big macro event, and the dollar significantly sold off after that. Now, just like any other asset class, sometimes these assets can overshoot, and it could be that the dollar overshot to the downside because of these expectations that China was going to inject stimulus into the economy. And as we know, that's really not been the case. And it's become more evident that that won't be the case. And I think that's now why we're seeing the dollar move higher, because rate differentials, which are big drivers of currencies, are now favoring the US. Rates in the US are moving higher or rising faster than rates in Europe and China, given this economic weakness that we're seeing there relative to what we're seeing today in the US, which is not really related to the Fed anymore in terms of hiking, for example, but it's more related now to the term premium, which is the compensation that investors require or demand, given these concerns around interest rate risk and holding bonds, and that relates to the massive supply of Treasury, and also the concerns around the demand for bonds weakening. And if you look at quantitative tightening, the Fed is not anymore a big buyer of U.S. debt, and therefore the neutral rate, which is the equilibrium rate that prevails when the economy is at full employment and is not generating inflation, that neutral rate there are concerns that it could move higher as this supply of treasuries increases. That's been empirically proven that the neutral rate globally, if you look at different advanced economies outside the US and even in the US, it's been mainly driven by the net supply of treasuries or safe assets. So if the net supply of treasuries is declining because the Fed has stepped back, the banks have stepped back for years now, Japan potentially steps back, then if that's the case, the neutral rate could move higher. So that's a concern for those precious metals, for example, because they could move. The dollar has more room to rise as rate differentials continue to favor the U.S. and these rates in the U.S. move or rise quicker than they do in Europe and in China.
Do you think that gold has stood up relatively well, considering how attractive interest rates have been in the U.S.?
Yeah, if you look at gold and if you look at things like silver, for example, two of the key drivers that we look at are the dollar and real rates. Mm-hmm. I think between the two, between silver and gold, in our work, we have shown that the dollar plays less of a role in impacting gold than it does with silver. So I think in the case of gold, you tend to see perhaps a little bit more optimism that we have peaked in terms of rates, because rates carry some big weight in gold, more so than in silver. Mm-hmm. So from that standpoint, I think when you look at the two asset classes, it's perhaps not that unusual that gold has held up better, because there is this gold, in my view, it's pricing in that we have seen the peak in yields, and therefore, it's not going to get that much impacted by the dollar rising compared to something like silver, which is very much a lever play on the dollar. Silver gets really impacted when the dollar is strengthening, and that's why I think we've seen bigger weakness there. So to really understand the pathway here for these precious metals, you really have to have a view on what's going to happen with the dollar and what's going to happen with real rates.
One market that has really been outperforming is uranium. So, Alfredo, if we took a look at what has been driving the recent run in price and compare it to the participation of speculative entities in the space, like the Sprott Uranium Physical Fund, what does their level of participation in the market recently tell us about the ability of the market to service or to provide material?
Yeah, that's something that's very interesting in the uranium market right now. That if you look at it since 2021, if you look at spot price in uranium, a lot of the upside that we've seen since 21 has been driven by the speculative activity, like the fund you mentioned, Spot. That kind of explains, what we've seen since 21, this big surge in prices. They've been a key player in buying volumes of uranium in the spot market. And so they've been quite influential. But this year, for example, what you've seen is that they haven't really been that active and participated as much, and yet we have seen uranium prices move higher. Mm-hmm. So there seems to be a different dynamic here than what prevailed since 2021, and we think that a lot of that has to do with demand from utilities. If you look at the demand from utilities from a long-term contracting standpoint, it has been pretty strong this year, and it was very strong last year, and this year is looking like it's going to be even stronger. So that's been, I think, a change in the dynamic of uranium prices that's worth considering, because that is more of a fundamental driver of the price action, mm-hmm. which means that the price could have legs today. And what's driving that demand from utilities? Well, there's a couple of things. One is, I think they're hedging the potential concerns around supply being cut off from Russia. I'm sorry. Russia is a big enricher of uranium. And there's, it could be the case that Congress bans imports from Russia, just given the war. From that standpoint, utilities in the U.S. and non-U.S. are trying to hedge that risk and engaging in long-term contracting to ensure supply. And also, second, is that you have, in the next decade, you're going to have a big deficit in the global supply of uranium. So utilities are also hedging against that concern. So from that standpoint, there is some fundamental explanation with what's going on in uranium prices more recently, and that could continue. We would say that if you look at something like the URA ETF, the miners ETF, they're very much discounted relative to the spot price of uranium. So as a long-term investor, you look at that and you can say that there's perhaps a good opportunity there as a bet, as a lever bet on uranium spot prices for something like uranium miners to catch up. Mm-hmm. And for that, you would need to see risk sentiment improve, in our view, because I think risk sentiment is an important component that drives prices of the uranium miners, because they just have, a lot of these are publicly traded companies, so they have an equity component in their returns, in addition to the spot price, which is another component. So if you see the risk sentiment improve, then these stocks could really do well and really close that valuation gap relative to the spot price of uranium.
Yeah, I think it's going to be really interesting to see, if the spot price continues, to see that shift in sentiment and appetite of risk going into the miners. But
yes,
Alfredo, another form of energy, and obviously more importantly to the economy as a whole, is the oil price. As these price spikes in oil that we've seen over the past decade, or let's say past couple decades, are associated with recessions because of the restrictive nature of high oil prices, has this last spike proved to be an outlier in that understanding?
Yeah, the price spike that we saw in 2022, when you look at the history of spikes in the real price of oil, so adjusting for the purchasing power of the economy, for example, if you look at a divergence or a dispersion of the current price relative to the 12-month trend, something around 35-40% the dispersion is actually something that's been consistently triggering recessions going back decades. That's not to say that it's the only thing that you need to see a recession, but it can certainly help precipitate one. In 2022, we saw a massive increase in prices and definitely breached that threshold that I just mentioned, but yet we didn't see a recession. And I think a lot of that has to do with this idea that the fiscal stimulus was something that we need to take into account, and that helped insulate the economy against this big spike in the price of oil. So from that standpoint, the question is, well, if we see another spike today, is it going to be the same? We're not going to see any type of impact to the economy, and I think that the answer, in our view, it would be well, no. I mean that's a much different. We're in a much different state of the cycle, and the consumer is already depleted in terms of excess savings. As we mentioned, there are some other headwinds related to the student loan moratorium and also the delinquency rates increasing, and the labor market also cooling and not being as tight as before, with the quits rate now being at the same level as it was before the pandemic. So I think in that case, if we get another oil shock, it would be different than what we saw in 2022. The interesting thing is that if you look at oil versus, let's say, break-even rates, inflation break-even rates, which are a market proxy for the expected inflation over a certain amount of time. If you look at, let's say, 5-year break-even rates that track the expected inflation that the market is pricing over the next 5 years, mm-hmm. then it's quite evident that the bond market and inflation markets are not expecting to see this big ramp up in inflation from the rise in oil. And that could be that the bond market is saying, hey, the consumer can't really take this, and It's very different from what happened in 2022 when you had the oil shock from the invasion of Ukraine by Russia, where break-even rates did spike alongside the price of oil. This time it's been different. The bond market is saying, I don't think so. And the consumer is not in the same position to withstand this type of increase in oil prices. And I think, in terms of should you believe the bond market or the oil market, in terms of where are we heading the economy as far as this rising oil prices, we put more faith in the bond market, because if you study it since the pandemic, it's been the break-even rates that I just mentioned, they've been actually more telling. They've been more prescient in calling out these inflection points in oil. They called it out in terms of the rebound of the economy or the reopening of the economy in 2020. These break-even rates moved higher before oil prices did, and same thing during the war in Russia. They peaked earlier than crude oil peaked, in essence, anticipating that this supply shock wasn't going to be long-lasting in terms of the impact to inflation dynamics in the U.S. So if you look at it that way, then it's difficult to say that we should expect a big runway in oil prices today. In our view, we think we might get to $100. That's certainly what you would expect, just based on where break-evens are, where the dollar is, which are two key macro variables for oil. So if you look at it that way, we would say $100 is probably what would be fair. Mm-hmm. But anything outside of that, we could be wrong. Anything outside of that, anything over $100, say $110, $120, then that could have some serious ramifications for the economy, because that's not really being priced in the market. If you look at the forward curve, it's not pricing, at that type of move. Mm-hmm. So that would be pretty disruptive.
Absolutely. I think barring some type of a black swan, the indicators aren't pointing, as you say, from the bond market to a materially higher oil price from here.
Absolutely.
Excellent, Alfredo. Well, I think that's a great place to kind of wrap up today's conversation, unless you have anything else that you'd like to add.
No, feel free to follow me on Twitter. Alfredo J. Pinel is my handle. And I'm happy to provide actionable insights to my followers and share some of the work that we do at Game of Trades. Feel free to also check the website, sign up for a free trial. We'd love to have you in the service.
Mm-hmm. And of course, that's at gameoftrades.net. And of course, you guys provide a ton of really excellent charts that you guys, I guess, analyze yourselves. And you post all of them on Twitter as well, at gameoftrades_, right?
Yes, the work that we share on Twitter is only a subset of what we do on the website. For our premium members, we provide a lot more perspectives and a lot more details on the website. The work that we provide on Twitter is meant to provide a sample of the type of work that we do. But yes, we do a lot of work on different asset markets, commodities, precious metals, equities, non-US equities. So we do a lot of work at Game of Trades, and we do our own work. As you notice, from our charts, as we mentioned in the beginning of the conversation, we have great capabilities at the firm with people that have experience in the industry. So we're able to provide these types of insights for our members.
And of course, actionable trades based on that information, right?
Yes, we can provide some strategy around the trades, how to structure them. We can definitely do that in our articles. So that's something that we don't share on social media. We think that's a very high value added product that we have on the website for our members. But we can provide actionable insights with strategies on how to execute these trades. So to ensure that you can capture the highest risk reward in the market today.
Excellent, Alfredo. Thanks so much for your time today. Really appreciate it.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.